Welcome. Every number in a company's financial statements has to come from somewhere, and the place it all comes together is the month-end close. In this section, you will see how the close assembles the whole business into one reliable set of statements, the 6 phases it moves through, and the day-by-day timeline that gets you all the way to a regulatory filing. Let us get started. By the end of this section, you will be able to explain why the close sits at the center of financial reporting, pulling every other cycle into the statements. You will identify the 6 phases the close moves through from preparation to regulatory reporting. You will describe the 3 types of close: the soft close, the hard close, and the year-end close. You will define 2 foundational ideas: cutoff and subledger lockdown. And you will apply the close day timeline that runs from period end all the way to filing. Here is the key thing to understand first. The month-end close is the culmination of everything the business did during the period. Every sale recognized, every invoice paid, every asset depreciated, every wire transferred, all of it flows into the financial statements through the close. That makes the close a kind of hub. It receives the outputs of cycles 1 through 6 and assembles them into one picture. The surprising part is what that means in practice. If any upstream cycle has an error, the close is where it surfaces. If cutoff is wrong, if an accrual is missed, the statements are misstated. That is why we start here, with why the close matters so much. Now for something that surprises most people. The close is not just an assembly line. It is the primary battleground for earnings management. Management override of controls, usually through manual and topside journal entries, aggressive estimates, and premature or deferred revenue recognition, is the most common form of financial statement fraud. Think about why. The close is the last moment before the numbers go public, so it is exactly where pressure lands. That is why the controls in this cycle, especially around manual journal entries and estimates, are the highest priority inspection areas for the Public Company Accounting Oversight Board. The PCAOB keep that tension in mind as we walk through the phases. So how does the close actually move? It runs through 6 phases, A through F, across 24 stages. Phases A and B cover preparation and adjustments, getting clean data in and posting the entries that make it complete. Phase C makes sure every single account is reconciled. Phase D produces the financial statements themselves. Phase E builds the management reporting package for internal leaders. And Phase F covers reporting to the Securities and Exchange Commission, the SEC, plus the external audit and the extra year-end procedures. The reason this sequence matters is dependency. Each phase rests on the one before it. We will spend most of our time in Phase A, where the close is set up. Not every close is the same, and knowing the difference saves a lot of confusion. The soft close, sometimes called a flash close, is a preliminary close, usually around day 2 or 3, that gives management early results. It has most routine entries but may still be missing some final accruals and estimates. The hard close is the real thing, complete, with all entries and sign-offs, and the period gets locked in the system, typically around day 7 to 10. The year-end close is a hard close plus extra procedures, things like physical count reconciliation, goodwill impairment, going concern, and a full audit. Same machine, 3 different settings, each for a different need. How do you know if your close is good? You measure close velocity, the number of calendar days from period end to final financial statements. A world-class close hits management accounts in 3 to 5 days and full financials around 10 days. An average close lands management accounts in 7 to 10 days. A poor close drags out to 15 days or more. Here is why velocity is more than bragging rights. The faster and more controlled your close, the more time you leave for review and audit before a hard regulatory deadline. Speed and quality are not opposites here. A disciplined process delivers both. Let us open Phase A with its backbone, the close calendar. Why does a calendar matter so much? Because without a formal one, the close degrades into an ad hoc scramble where tasks get forgotten, deadlines slip, and the statements cannot be relied on. A proper close calendar defines every task, its owner, its due date in business days from period end, any predecessor tasks, and the deliverable that proves it is done. One detail matters here. The owner is a named individual, not a department, because shared accountability is no accountability. A status dashboard tracks each task in green, yellow, or red. In practice, this turns a chaotic month-end into something you can actually steer. The close calendar is really about managing dependencies, and this is the controller's most critical responsibility. Tasks chain together. Revenue recognition cannot be finalized until accounts receivable, AR, is locked. Expense accruals depend on vendor invoices received. Intercompany reconciliation waits until every entity has posted. The trial balance cannot be finalized until all reconciliations are signed off. Because of that chain, there is an escalation protocol. Any task at risk of missing its deadline must be escalated to the controller at least 24 hours before it is due, so corrective action is still possible. Without this, a single late critical path item delays the entire close and the statements behind it. The dependencies are the close. Now the single most fundamental idea in the whole close, cutoff. The rule is simple to state. Every transaction must be recorded in the period it belongs to, and not in the wrong period. Get it wrong, and you inflate or deflate current results at the expense of a future period. Each area has its own cutoff. Revenue is recorded only when control has transferred under the revenue standard, so no invoicing ahead of delivery to hit a target. Expenses incurred through the last day are recorded or accrued even if no invoice arrived. Inventory receiving and shipping are reconciled so nothing is double counted, and payroll through the last day is accrued even if it pays out next period. Cutoff is where integrity lives. Once cutoff is applied, you have to seal the period, and that happens in a deliberate sequence. The subledgers are locked in order. AR first after the last billing run, then accounts payable AP after the last payment run, then inventory after the cycle count is reconciled. Why the sequence? Because locking prevents late posting that would force you to rerun the whole close. After the subledgers, the Enterprise Resource Planning System, the ERP, closes the period itself, but only after every calendar task is done and the controller has signed off. From that moment, no ordinary user can post to the period. Only the system administrator can, and only with explicit controller authorization. The period is now genuinely closed. Before the close can really proceed, the controller confirms that every upstream cycle has finished its period-end work. There is a checklist for all 6. Revenue, with the final billing run and deferred revenue updated. Procure to pay, with the payment run done and goods received not invoiced, GRNI, accruals prepared. Payroll processed and accrued. Inventory counted and valued. Fixed assets with depreciation posted. And treasury with bank reconciliations complete. Here is the discipline that matters. This confirmation is documented, not assumed. The controller needs formal sign-off from each cycle owner. Any cycle that is not complete blocks the close until it is resolved. You do not build statements on cycles you only hope are finished. Let us put it all on a calendar. Day 0 is period end, the last billing, payment, and payroll runs, cutoff applied, lockdown begun. By day 1, the AR and AP subledgers are locked. Day 2 brings the flash report, the soft close with payroll and GRNI accruals posted. Day 3, all accruals are in. Day 4, every balance sheet account is reconciled and intercompany agreed. Day 5, the adjusted trial balance is final, flux analysis done, controller sign-off given. Days 6 and 7, the statements are drafted. And by days 8 to 10, the full management accounts package goes out and the board package follows. That is a clean, controlled month-end from end to end. For a public company, the timeline does not stop at management accounts. It continues onto a regulatory runway, and these deadlines are fixed by regulation, not by preference. Around day 15 to 20, the quarterly report draft, the 10Q, is filed internally as review begins and the XBRL tagging is completed. Between day 40 and 60, the 10Q is filed with the SEC with the required certification signed. And between day 60 and 90 after year-end, the annual report, the 10K, is filed through EDGAR once the full audit is complete and the report on internal control is signed. Here is why velocity mattered earlier. The close must be fast enough to leave real time for review and audit before these dates arrive. Let us bring it together. The close is the hub that assembles cycles 1 through 6 into the financial statements, which is exactly why it is also the main battleground for earnings management. It moves through 6 phases, A through F, from preparation to regulatory reporting. Phase A sets the foundation with the close calendar, the cutoff concept, the subledger lockdown sequence, and a documented confirmation of every upstream cycle. The close day timeline carries you from day 0 through management accounts and on to fixed SEC deadlines, which is why close velocity protects your time for review and audit. Next, we turn to accruals, estimates, and contingencies. Thank you for completing this section on the close process framework.